Hey everybody, welcome back to my Monday market update. This is Roy May, and this is brought to you by Bach Realty Group and Pilgrim Mortgage, our friend over there, Mitchell Kleckley, one of our preferred lenders. So let's get into it. As I said last week, the job report was set to be released, so let's start there. The Bureau of Labor Statistics reported that there were 187,000 jobs created in July, which was weaker than estimates. Job growth in May and June was also revised lower. They subtracted 49,000 jobs in those months combined. The unemployment rate fell, though, from 3.6 to 3.5%. So what's the bottom line? The headline job number comes from the report's business survey, which is predominantly on modeling and estimations. In fact, one of the biggest reasons we saw job gains last month was the birth-death model, and that's where the BLS estimates business creation, the new business creation relative to closed businesses, and then how many jobs that creates. In July, this modeling added 280,000 jobs, but it's kind of hard to believe that many businesses were started last month in the current economic climate, especially given the cost of capital. So job gains are clearly slowing, as job growth in June and July were the two lowest levels reported since December 2020. A deeper look at the data shows that part-time workers increased by 972,000, while multiple job holders rose by 118,000, meaning some people are having to pick up second jobs to get by. And full-time workers also fell by 585,000. So average weekly hours also declined slightly, which is important because one of the ways that businesses tend to cut costs is to cut the number of hours worked. This caused average weekly earnings to only increase 0.1% from June. So overall, that this data kind of tells us is that there's an underlying weakness in the job market and economy in general. Initial jobless claims, so unemployment rose by 6,000 in the latest week as 227,000 people filed for unemployment benefits for the first time, initial claims. And while that number can be pretty volatile from week to week, first-time filers have remained under 230,000 for the last 3 weeks after topping 260,000 in the first 3 weeks of June. So this tamer level of the initial claims shows that employers are still clearly trying to retain their workers. Meanwhile, continuing claims rose by 21,000, with 1.7 million people still receiving benefits after filing their initial claim. And while this latter metric is well above the low of was 1.289 million seen last September, it's declined from a high of 1.861 million reported in early April, reflecting a mix of people finding new jobs, and some of that is also just benefits expiring. I wanted to bring this quote to you. I saw it from her because it's Erica Edelberg, Bloomberg strategist, gave the following kind of brief market overview. It says, although the end of the Fed tightening may be nearing, the U.S. rates are still being pressured by strong employment and economic data, which may force the Fed to keep short rates high for an extended period. Expectations for increased Treasury supply and this week's credit rating downgrade for U.S. Treasury and agency debt have added even more pressure. Concerns about the loosening of Japan's yield curve control measures, which could decrease Japanese demand for U.S. assets, have contributed to the recent rate sell-off. The rate sell-off has pushed mortgage rates back up near cyclical highs. The latest MBA loan application data for both purchases and loans are already hovering near all-time lows based on last week's rates. This week's sell-off could push those even lower, further limiting mortgage-backed security issuance. So that's coming from somebody who literally on a daily basis does this for Bloomberg. So I want to talk a little bit about the home. So the home price index, it rose for I believe the third straight month. It was the fifth straight month. It was up 0.5% from May to June. Prices were also 1.6% higher when compared to June of last year, and CoreLogic forecasted home prices will rise. They rose another 0.6% the next month and 4.3% in the year moving forward. So what this tells us is that home values have increased 4.8% this year. They're forecasting that home values will rise 6.3% from June 2023 to June 2024. And predicting that 48 of the nation's 200 largest markets will see increases of 7% or more. So what's that really mean, right? The latest rise in home prices reported by CoreLogic and Zillow echoes the strong growth seen in other appreciation indexes, which includes the Federal Housing Finance Agency. Tight supply is a key factor impacting the prices. We all know that the inventory is low, and the continued imbalance between buyers and sellers, it's going to continue to pressure home prices. And that's why home ownership still remains a good investment for opportunity for building wealth through real estate. You know, owning real estate is is definitely one of the springboards for wealth, quite frankly. So I just kind of want to let you guys know. I knew last week I'd said that the job report was coming out, so kind of crunch through that data. Again, a lot of this stuff is nerd kind of stuff, but I love numbers. And it's a good way to see what's going on, especially when we get those larger reports like the labor statistic reports. So I hope you guys enjoyed it. And I'll be back next week with another Monday market update. And thanks to Bach Realty Group and obviously Mitchell Kleckley over at Pilgrim Mortgage. And that's it for today. So it's my birthday, so I'm gonna go enjoy the rest of my day. But thanks for stopping by.